Morning, everybody. Good to see everybody. Thank you for coming. Welcome to the update of Creightons interim results for the first half of our trading year. I'm going to do a little bit of an introduction, and then my colleague Qadeer on the finance side is going to give you a bit more information on finances, and then I'll come back on and do a bit more about strategy in the business in terms of what we've been doing. And then Paul is going to join us, our chairman, at the end for a Q&A. So just a bit of a company introduction for those that aren't familiar with the business, just an update. We design, develop and manufacture products in the beauty industry and the personal care sector in a very wide range of categories. I think it's about 14 different categories now that we do in the beauty sector. We go to market through 3 revenue streams: private label, where we manufacture for retailer brand, our own brands that we own, that we've either developed and designed in-house and brought to market or we have acquired, and contract manufacturing, where we manufacture for other brands. There are now 380 of us across 2 sites in the UK, one in Peterborough, one in Tiverton and Devon, both manufacturing sites. Peterborough being the head office and the main functions of what we do, plus manufacturing, and then a smaller site down in Devon. There's about 80 of that 380 down in the Devon, and the rest are in Peterborough. Most of what we do for all of our private label and all of our own brands is what we call full service supply. So that means we buy all the components, we design, we develop the formulations, we obviously manufacture it, we warehouse it, we forecast it, we manage the EPOS, and we deliver day 1 for day 3 or day 1 for day 5 into all the big retailers in the UK and international markets. We're award winning, both in product and in terms of the service that we do to retailers. We pride ourselves on our performance and quality of our product. We are always working with key retailers on innovative solutions to help them grow what they're doing in the beauty market. And the products that we do have global appeal. In terms of how those revenues are split, a comparison to first half of last year, you'll see it's changed very slightly in terms of the percentage contribution of revenue into the business. So contract manufacturing gone from 18% of what we do to 14%. Those of you that know our business know that that area of our business has been declining somewhat in the past couple of years. Private label is now 53% of what we do versus the 44% this time last year, and branded from 38% down to 33%. So some operational highlights in terms of what we've been doing for the past 6 months. Our private label business is doing extremely well, up 17.4%. There's 2 reasons, really, 2 key reasons. Number one, it's very much on the agenda of UK retailers at the moment. Having done this for a very long time, you see cyclic effects over time of retailers wanting to prioritise private label or wanting to prioritise brand. So you go through these kind of cycles, and at the moment, private label is definitely very much on the agenda. It's very margin enhancing to retailers, and it's always something that they like to do when the consumer's very tight on spend, because it's an opportunity to put product out on the market at a slightly cheaper price. So doing very well in private label. Our brands are 15% down for this first half year, which is about £1.5 million. £1 million of that is as a result of the discontinuations we did of the tail products the year before. And we also discontinued another brand in the period as well. And then contract manufacturing, as anticipated, has declined another 21.5%. Again, when we presented at year end, we outlined that that division was really suffering from brands that we were manufacturing for that themselves are not performing, so therefore we don't get the orders. And also we weren't able to get credit insurance from a number of people that we were dealing with, so we've pulled out. So we have a policy in our business post-COVID, we credit insure everybody that we deal with. So in terms of the other things that are going on operationally, our customer pricing strategies from the past year have worked really well, driving our margin up another 1.8% to 44%. We've kept our overheads and our admin costs under control, so we've reduced them by another 4.8%. Our distribution costs continue to decrease. We've bought most of our finished goods in-house now. Again, a program that we started last year, but that's still paying dividends for us. And we've reduced our stock levels from this time last year from 10.4 to 8.7 million. So just some financial highlights before I hand over to Qadeer. So an improved performance on lower revenue is really the theme of this first half, with the gross margin driving that, operating profit going up, EBITDA going up to 2.5 million, cash on hand going from a negative position this time last year to a positive position, and an improvement on the diluted EPS. So Qadeer is going to take you through some of the finances in a little more detail.
Hi. The results for the period to September 2024 essentially are a continuation of the themes that we outlined in our annual report to March 24 and also in the interim statement itself. Despite a decline in revenue, essentially gross profit margin and operating profit are increasing. On the right hand side, you can see the revenue split by revenue stream for the last 5 interim periods. September 2020 was the highest revenue at 32.4 million. A huge portion of that was 35% in relation to hygiene sales. So that was obviously an exceptional revenue stream, largely due to COVID. Excluding that, you can see the trend from September 2020 to September 21 was actually a significant period of growth. Revenue for September 21 was 30 million, September 22 pretty flat at 29.7 million, a reduction in September 23 to 27.6 million, and a slight reduction to 27.1. So excluding hygiene in 2020, we can see an upward trend in revenue over the last 5 interim periods. As Pippa mentioned, the private label continues its sales momentum and now forms 53% of the overall revenue for the interim period. Contract and branded sales continue to be challenged. Gross profit margin is showing an upward trend. So similarly to the previous slide, the chart goes back to September 2019 and effectively shows gross profit margin increasing from 42% to 44% in September 24. There are 2 notable dips in terms of that gross margin upward trend. In September 2020, we had 39.3%, which was largely due to COVID, increased costs in terms of air freighting those goods, and also a reduction in productivity. Social distancing rules was a factor in that. And then September 22 was really at the height of inflation. There's increased direct costs due to the global supply chain and also inflationary pressures. And as a business, we were challenged in terms of passing that cost on to customers in a timely fashion. So essentially we had those costs, and you had to bear the brunt of those costs before passing them on in future years. The increase in gross margin is really a testament to the system and processes the business has put in place. Cost price increase monitoring across all categories of supply allowed us to negotiate with customers and use that as a basis for increasing our customer selling prices to those customers. As well as product re-engineering and product reformulating allowed us to improve those gross margins over the last couple of years. Again, despite a reduction in revenue, the operating profit before exceptional items has increased significantly. September 2024, we're at 1.7 million. So even though revenue has been declining over the last interim periods, we can see the conversion of that into the bottom line profit and operating profit is actually quite significantly improved. As Pippa mentioned, we undertook a strategy of cost rationalization, effectively aligning our overhead base with the level of sales activity. That allowed the business to implement a strategy of tight cost control. Distribution costs as a result have decreased by 25.3%. Again, bringing back logistics and picking and packing in-house accounted for 0.3 million of that reduction. Administrative costs decreased by 4.8%, as well as the cost rationalization across the group. The integration of the Emma Hardy business into the main trading subsidiary led to 0.3 million in terms of overhead reduction. In terms of cash, again, due to the strong operating activities, the business was able to generate 2.5 million from its operating activities. In terms of working capital, the cash consumed of 1.77 million, that's largely split into 2 main components: 0.5 million increase in stock, and the remainder 1.3 million is largely due to net increases in debtors and creditors. Investing activities, which pertains to purchasing of plant and machinery and equipment, used cash of 0.25 million. And financing activities, 1.36 million cash used, includes the full repayment of the term loan, which was used to acquire Brody & Stone business and also Emma Hardy. That accounted for a 0.6 million payment during the year, and then the dividend payment of 0.3 million in the same period. The sum of all those equates to a 0.9 million reduction in cash on hand. I'll hand back to Pippa.
So our strategy in summary, in terms of what we've been focusing on and will continue to focus on moving forward, comes into these different categories: building brands, growing our private label share, developing teams and people, maintaining our core stable foundations that we've built over the past 6 months, being an R&D focused business, and investing in our manufacturing facilities to extend our capabilities. So just going through each of those in detail and giving a little bit more for each of those topics. So building brands, obviously a priority for us. And I thought it would be good if I was to split out for you kind of how we look at our brands. We're currently focusing on 8 brands. We Previously, we're trading with about 11 brands, so we've kind of cut that back with some of the rationalization we've done. So we have must-win brands in Emma Hardy, Feather and Down, The Curl Company, T-Zone and Balance Active Formula. 3 of those we acquired, 2 of those we developed in-house. We see Janina and Natural World as 2 development brands, both purchased with the Brody and Stone acquisition. And we use Creightons for our trading brands and for any exclusives that we do with the market. So just kind of giving you an idea of how we look at each of those 3 brands from an investment point of view and where we are in the life cycle of developing those brands. So what is important, we feel, in building those brands is having a very strong pipeline of new products. So I know we've talked a lot about getting rid of the tail over the past couple of years in terms of products that aren't performing either from a volume or a margin perspective. It is important that we continue to bring new products to market that actually will perform better from that and deliver more value to the business. So we've put a strong pipeline of new product development in, particularly for the must-win and the development brands. Increasing our store footprints, no matter where we are and where we're listed, with better shelf position, more stores and more listings, which is essentially the fundamentals of getting more awareness on our brands in retail. And increasing our direct to retail international markets directly with retailers. One of the aspects that's been a feature of the branded sales having a decline this half year, is the discontinuation of brands and products that we've done, but also we've had 3 international distributors that have not performed. So we have since exited from those distributors. That has had the most impact on the Balance Active Formula brand. The model that we've had historically of trying to go direct to retail where we can in international markets is a much more successful model for us. And hence, that's why a focus for us moving forward is to get ourselves listed directly with retailers and not through distributors in international markets. Ensuring that we have clear brand USPs and consumer targets for every brand that we have and knowing where we can win. Adding additional brands, whether that's something we develop in-house or whether that's something we acquire. And then digital investment. We've got a pretty strong digital team now. I have a new head of digital in the business that joined us 2 months ago. We're focusing a lot on our Amazon business, our .com business, and actually stretching into other digital platforms globally as well. Growing our private label share, particularly in the UK market, which is where we operate almost exclusively. Very important for us in terms of what we do. We currently have 9 customers. One of them is international. We operate in 9 categories. We have 323 products we do in that category, and we're in 4 markets, UK being the biggest. Again, strong pipeline of new NPD is important in private label to ensure that you're constantly bringing newness and meeting consumer need and demand. Expertise in the category, to me, actually would probably be the biggest priority in private label. You find with what we do direct with retail, particularly the big grocers and big drugstores, is they need a lot of guidance and a lot of expertise in terms of understanding what sort of products they should be doing and how they can execute that in a private label way under their own brands. Forward planning, this is actually quite a new feature in private label. We're now able to plan about 12 months in advance with key retail partners with new product development programs and in terms of what we're going to do category by category. Obviously, it's a very margin positive category for us, so focusing on margin positive products is important and extending our expertise. So growth in private label in the UK market, particularly where we're covered well, is to gain expertise in other categories that we're currently not operating in the private label beauty area. Developing our team and people, this has been a really big priority over the past 6 months. And in fact, one of the features as to why private label is doing so well is that we finally have a full private label team. Since post-COVID, we've had vacancies in that area that we've struggled to fill. And for the first time in quite a while, we now have a full private label team, which is quite exciting. And I think that acceleration in terms of what we're doing and how we're growing in that area is part of it. So in terms of the wider thing about developing our team and people is on an operational level where we've got operators in the manufacturing area, we've developed a grading system so that employees have an opportunity to earn above the national living wage by adding new skills in a grading system that we've developed. We've got a number of apprenticeships going on and we will continue to do that. They're very successful for us. We've got some really great team members coming through that have completed some fairly extensive apprenticeships qualifications. Upskilling our manufacturing teams, very important. And investing in our sales and brand expertise. We're not quite fully staffed on our branded side of the business with sales-facing personnel. So that's a real priority over the next couple of months is to fill those gaps. We're 10 years in running our graduate program that's been very successful for us in terms of bringing people through the business. Our head of R&D is an ex-graduate in our business, our head of purchasing. We've got a number of people that have come through the business. So growing our own has always been a very positive thing for us. And more recently, we started a coaching and mentoring process with both internal coaching, one-to-one mentoring, and external that's worked well for us. And I thought I'd just show you our long service awards. We do this every year. This is for people that have been in the business 10 years or more. So maintaining the core stable foundation of the business, you can see this has been the big focus over the past 6 months. This will continue to be a theme for us. I think particularly in terms of the headwinds that are coming in 2025 with increases of labour costs, I think it is likely that we may go into a bit of an inflationary period over the 25-26 trading years. So I think ensuring that we keep focused on these basics and make sure that we're performing well in these areas is important. So keeping our costs in line with revenue activity, continuing to be a margin-focused business, ensuring that we're controlling our cash and we're generating cash, keeping our stock well managed. There's still more that we can do there, and we've been doing that over the past couple of months, and making sure that we have a well-trained and skilled workforce. Being an R&D business, very important for all types of business that we do, making sure that we're constantly bringing new ideas and new products to market, A, so that we can get to market quicker, B, that we can extend what we're doing in terms of new technologies. So I'd mentioned probably over our past 2 presentations that we have been developing SPF formulations for the past 18 months. Very exciting that we're going to be launching our first 5 SPF formulations in the new year, 4 with Balance Active and 1 with T-Zone, with 30 plus and 50 plus formulations, which is really quite exciting. There's more work to be done in SPF development, so we will continue with that. But also looking at new skincare technologies as well as the skincare category gets more and more competitive, but also more and more demanding in terms of what consumers want. So we're focusing on formulations that tackle the microbiome, for example, skin health, hyperpigmentation, and I'll keep you up to date with that as time goes on. Working with cutting edge textures and formats, which is really what drives our industry. Consumers are always looking for something different in terms of how products look and feel. The kind of sensorial nature of product is really important. So always consumer need focused, keeping an eye on sustainable sources, ingredients, not just for ESG targets with retailers and ourselves, but the consumer is looking for those kind of stories too. And in order to help facilitate that, we created a role in the past 6 months in that we have an individual now that is a very high performing chemist, but she's very good at customer facing and very good with trend. And she now sits in a pivotal role between our R&D teams and our sales and our brand development teams. And we're finding that that's creating a very positive link to ensure that we're joining up the dots all the time in terms of what we're developing and what we're working on and making sure we're getting out into all areas of our markets. So manufacturing capability investment, we've been doing quite a bit of this over the past 6 months and will continue to, looking a lot further ahead than we have traditionally, but really focusing on some key priorities when we look at investment opportunities to increase capacity, to increase our flexibility and improve our labour efficiency and utilisation, which obviously that third one is critical with what we're facing into with the UK as labour continues to get more and more expensive. And I don't doubt that, in a year again time that the minimum national wage will go up again. So we have to make sure that we're continuing to look at our labour efficiency and utilisation with the investments that we make. And then also the opportunity to extend our capabilities would be a priority in there as well, but we'd probably put the first 3 as the top priorities. And that is going to be delivered through AI and automation solutions. We've always been an incredibly flexible business. It's a USP that we have in the industry. We don't run products for 3 or 4 days at a time that you would perhaps expect to see in some high, low value, volume businesses in the beauty and household sectors. We can change a production line sometimes up to 3 times a day in terms of the products that are run on that line in an 8-hour shift with different types of packaging, whether that be big bottles, small bottles, jars, tubes, all different things. So we've always kept ourselves incredibly flexible. So automation issues traditionally have been really difficult for us to realise because they don't give you the flexibility. But AI and automation is coming on quite significantly in terms of what's possible now. So we've seen some really interesting things in the market that I think we can invest in moving forward that will keep our flexibility, but will also enable us to become more efficient in terms of how we use labour. In summary, for the first 6 months of the year, we've been building a core foundation for a higher growth, sustainable business. We're profitable, we have a strong EBITDA, we're cash positive, and we're low geared. We have a very focused and remotivated team. That's been a big priority over the past 6 months in terms of getting everybody facing in the same direction, everybody on the same page and heading towards the same goals and objectives. Sales team investment. I have a new director of sales in, which is very positive. We have a new head of sales in the UK that's joined us in the past 2 months from Henkel. So really beginning to build that sales team, which is super positive. As I said earlier, still a couple of gaps, but working on getting those filled as soon as possible. So we feel as though we've built a strong foundation to position ourselves for growth, which is the priority as we go into next year. Increased brand investment. So we're spending quite a lot of time looking at all those individual brands and looking at what we need to do next with each of those brands to take them to the next level. And more investment is going to be required with some of those brands. And then the management of 2025 headwinds with some targeted improvement plans. So within hours of the budget coming out, we got together as a senior team. We sat down and went, okay, what's this going to cost us? What's it going to look like? We put some of that information in our statement. So it's going to cost us in terms of what we don't have a choice with of about £550,000, of which £200,000 is the increase of the national living wage. And the other £350,000 is the impact of the double whammy of the national insurance impact. We're actually targeting ourselves as a team as a £700,000 saving. And we've sat down and we've put down all the different things that we think we can do over the next 6 to 12 months in terms of battling kind of those oncoming costs and what we might be able to do in terms of savings in the business. And we'll work together very closely as a team over the coming 6 months, 12 months. And some of that may be things we can realise quite quickly, and some of those things are going to require investment and going to take a little longer to realise, but very much got our eye on what that's going to do to our business and how we battle those costs that are coming at us. And that's it. It's a Q&A.
Hi, Peter Enton from Cavendish. Can you talk a bit more about the impact of the performance on your branding part of the business? Why do you think there was particularly poor performance from those 3 distributors?
A couple of reasons. I think we just picked the wrong partners. So we're tightening up our criteria. I'm not a fan, if I'm honest. I never have been. I've probably said that many times at these presentations of distributors. I think it's a very old school model in terms of getting to international markets. But there are some regions in the world where you just won't go direct. So there are some regions in the world, areas of the Middle East, for example, areas of the Far East, where markets are very disjointed. It's a very fragmented retail structure and you need people on the ground. So there will be some distributors in our model, but yes, we've fundamentally picked the wrong partners. We've also had a very recent problem with counterfeiting with the Balance Active Formula brand, which has been quite extensive in some regions, which we're tackling. We're tackling it through coding, we're tackling it through doing different things to the products that we manufacture that makes it a little more challenging, more trademarking, more protection in some of those markets. And that's had an impact as well.
Do you have any medium-term financial targets that you're looking to achieve? Would be that revenue at a certain level, margins, profitability, etc.?
Yeah, I think in terms of our net margins, and we kind of highlighted this at the end of the last presentation, is that 5% on the bottom line is where we would want to be as a minimum. And we would aspire to get up to sort of 8 to 10%. That would be where we would challenge ourselves in terms of moving ourselves forward. In terms of bottom line return.
Is it a private label exposure that then you start feeling uncomfortable if that goes to 60 or 70%? Or it's fine even if it grows much, if it's internal, let's say, diversification, because there are many retailers. Is it like a limit that then you start feeling...
in terms of the private label opportunity?
In terms of private label sales, like the exposure, like if it goes to 70% of sales, is that something that might make you worry? Like, or you don't think of it, you think it's a positive that more retailers are coming in? How do you think about it?
It's a really good question, because when the business is there and we do it so well, you want to take it, right? So why wouldn't we? There is lots of growth potential in many of those retailers to still grow private label and for us to move into other categories of private label as well. I guess our desire would be to have our branded business growing at the same rate. And at some point would love to see our branded business as the lion's share of what we do. But you also have to go with what retailers want and what their agendas are. And I always say we have two customers. You're selling to the retailer, but you're also selling to the consumer. And sometimes those things don't necessarily align in terms of what the priorities are. So if the opportunity is with private label because they're putting more on shelf for private label, then obviously we're going to take that opportunity as well as trying to get our brands in as well. So I don't know if that answers the question. There is more stretch in private label. There's more that we can do. Would we like to see brands to be a larger share of what we do so that we are more in charge of our own destinies? Then, of course, that's what we would aspire to.
I think also it's quite important to understand the long-term nature of the business with private label. Some of these relationships have been going back 15 years,
16.
plus.
Our longest relationship is 18 years.
18 years.
On private label.
And the more and more you're embedded with them and have multifaceted links between them with R&D and technical and meet their standards, the stronger that relationship becomes.
I guess you have also leverage, like they have leverage because they are big, but you also have leverage because they can do their job and it will be a cost for them to shift or
Exactly.
Right?
Yeah.
And safety, product safety, it's their name on the back of that product at the end of the day. It's very important to them.
Hi there. Just in terms of margin, private label, and your own brands, what's the sort of margin profile but difference?
So at the revenue level, at that kind of gross revenue level, the margin structures are a little different, but when you get down to the net margins, they pretty much equalize out because we don't have to invest in private label brands, but we have to invest in our own brands. So we start out at much higher margins for our brands and would drive that forward, but we need to fund the promotions and the marketing efforts and the social media and everything that we do in terms of investing in brands, whereas private label is a pretty straightforward sell in terms of we invest in the product development. Beyond that, the retailer's investing. So when you get to the kind of the net margins, it pretty much equals out. But obviously we're in charge of what we spend on the brands, so we can vary that. But they take a lot to support, as you can imagine.
If I look at the business, you have a number of small brands, but actually thinking about the company as a whole, I don't understand how you're building the value of Creightons, the brand of Creightons. And if you look at other big FMCG businesses, you can see the value that they're creating in the intangible asset of the brand. And here, what effort are you doing to actually build the value of Creightons brand name?
It's a good question because the Creightons brand name has really only ever traded in the discount sector. We've always used it as a discount positioning branding. So if you look at the rest of our brands, so we have Feather and Down, we have Emma Hardy, we have the Curl Company, they operate in more of the what I would call mass or mastige positioning. So anything from kind of $3.99 up to 15, 16, 17 pounds. And obviously Emma Hardy quite far beyond that, the average price point there being about 55 pounds. So in a very different position. So I think the equity in Creightons brand isn't necessarily the focus for us. I think we as a board find the name a little challenging in terms of building anyway. It's not a name that you would choose necessarily to build as a brand, but it operates very well for us in that kind of discount space because it's known for quality and value and great product, great pricing. So really for us, it's about building the equity in the other brands that we have. And if you look at corporates, and I don't know what your reference is, but if you look at the P&Gs, if you look at the Unilevers, you look at the Henkels, Beiersdorf, if you're looking at those corporates, they all have completely separate branding in completely different categories. They don't actually use the corporate branding per se on their brands. So L'Oreal is probably the only one that uses it on pack, but then they've bought CeraVe and they've kept CeraVe, which is they've bought from the French, completely separate in terms of branding. They have not put the L'Oreal branding because CeraVe has a position in the body care market and the skin health market that works incredibly well there. And to put L'Oreal on it, I don't think would be the right thing to do. So it is about building equity in each of those brands, which is a hard ask. It really is, because you've got different identities in different categories, and you have to do that through consumer awareness. I mean, that's the way you've got to build that. And in fact, one of the points that I had on brand development, which is essential to brand awareness, is getting more stores, more shelf space. And that's probably where I would think you see the impact of some of those brands that you say are building equity in their brand is the shelf space when you walk into store. They have entire bays or they have full shelves. And that obviously is the goal for us, is to get as much shelf space and as much distribution as you can get, so that at point of sale, the consumer's walking in and seeing the Feather and Down brand, they're seeing the Curl Company brand, they're seeing Balance Active formula. And that's a challenge. I mean, that's where a lot of the investment has actually got to come as a next stage for us, is how you have to invest with retailers to get that shelf space and to get more stores and to get more coverage.
A completely separate question. If we look at the business in terms of sort of functions, and the volume that's going through those different areas of the business, thinking about the distribution part of your business, it seems as though you've got a very good sort of set of customers that could perhaps be very valuable to other businesses. So I wonder whether there's an opportunity to get some revenue from other customers, where you're effectively, a route to market for them. Just to get some relatively easy revenue just to add to your contribution.
I think, again, that's been a subject that's been put on the table for discussion. I think for us, our priority would probably be to start bringing in products ourselves that we don't necessarily manufacture, that we could add to brand or we could add to our portfolio. So that's very much a strategy point. We already do that in a number of our brands. So some of our brands, we don't manufacture all of those products that are on shelf. And in fact, our branded team do have to think outside the box with other technologies. So for example, we don't make sticks, and sticks is becoming a big thing in skincare, believe it or not. It used to be in the deodorant market. We found a stick supplier. We're going to start bringing in sticks on a number of our skincare brands for application of serums, for example. That's just one example, but we already have some. And in fact, behind me, you can see we're somewhere with the #1 nose strip brand in the UK. Believe it or not, we sell more nose strips through T-Zone than Garnier or Biore. We don't manufacture any of those. They come in from an outside source. So I think there is a way that we can take advantage of that through our own brands. Is there an opportunity with other brands? I think it would depend who it is and whether that adds value to what we're doing. So yeah, it's a point of discussion, I think, and making sure that it doesn't detract us from what we're doing elsewhere in the business.
Just on the private label side of your business, obviously it's a market that's growing anyway. What sort of forecast can you give us there?
Yeah, I don't think we're in a position to give forecasting to today. I think you'll find as our business moves forward over the next kind of 6 to 12 months, we'll be giving a little more information to the market in terms of what we're doing. That's definitely our intention. I think in terms of what's happening now, October and November have performed well, which I think is a good indication of what's happening in H2. And again, that's following through with those trends in private label and what's happening there.
Yeah, hello. Can I ask about your plans for digital investment and growth? So could you start by saying sort of what percentage of sales you currently achieve and what would be your aspiration sort of medium to long term?
So our total digital sales across the entire business, and I count in that where we're also working with people like the pure players in beauty like Sephora online, Look Fantastic online, our Amazon business, which we manage ourselves as platforms on our own .com. That total business for us right now annually is about £4 million. So it has grown quite significantly in the past few years. The lion's share of that being Amazon that we manage ourselves. In terms of where we would see that going, I'd like to see the digital business growing in line with the business. I think it's important, whether we do it ourselves on platforms, our own .com, or whether we do it with pure play partners. We have a team in-house that we've invested in. So we have 3 full-time people on our Amazon business and a head of digital that's kind of heading that up in terms of our own .com, our Amazon strategy. We've launched into Germany Amazon recently and USA Amazon recently with 2 brands. So yes, it's an important part of our branded development business. Feather and Down and Emma Hardy, about 40% of sales of each of those brands are actually online. So they are brands that translate very well online. So they're very much, when we look at the brand plans for those 2 brands, and it's because the price points work online. You need a price point online that takes care of delivery, and you're able to do promotions, and you're able to it makes sense that people will buy that online as opposed to some of the lower priced items that you will do and you'll buy in grocery or you'll buy on the high street. So yeah, it's an important part of growing our brands for sure.
Could you say what your sort of medium-term target is in terms of digital sales? I mean, do you...
I think when you say medium-term target, it depends what timescale you're talking about. But I'd like to see that. I'd like to see that business growing at like 10%, 10 to 15% year on year in terms of what we're doing on the digital space. That would be the goal.
I had a second question. Does your warehouse have capacity for the foreseeable future? If you grow
That's a good question. We've created a lot of space just by being better organised and consolidating and getting our stocks down and making sure that what's in the warehouse is stuff that we actually need to use and we can move through quite quickly. It has a little bit more capacity, but I think as the business grows, that's an area that we're going to need to look at in terms of either putting more out to a 3PL or investing ourselves in additional warehousing.
You referenced a strategic review in the interims. I wonder if you could expand on the scope or the focus of that.
The focus on that is predominantly in terms of our brands, in terms of what we want to do with those moving forward. As you can see, the private label model is one that is fairly clear in terms of where the opportunities are and what we need to do to realise those. I think with our brands, because it's not just UK, it's also international, and we have multiple brands. So that strategic review is really about what do we want to do with those brands? How do we want to invest in? Some of the subjects that have been brought up today are definitely part of that in terms of distribution, in terms of partners, in terms of other categories, in terms of how we might expand what we do in our branded area.
Make or buy,
yeah,
all of
but
those.
also fundamentals in terms of where we want to be as a business. What growth do we want to have in the business? What do we want to achieve in terms of, the basic financial fundamentals and what those targets would be. So that's something the board and I are working on early into the new year.
I was on the emmahardy.com website and there appeared to be quite a few out of stocks. And I didn't know if that's because they're flying off the shelves or...
That's also because we're rationalising the range.
Right, so they are products that you're
when we purchased the
discontinuing.
Emma Hardy brand, it's got a big tail. So that's just a matter of getting those off the site really as they get discontinued and they get taken down, and that's just a review process that needs to happen. So yeah, that's mainly because we're cutting the tail off the Emma Hardy brand in the main. Yep.
Is it worth mentioning about the recent rebranding on Emma Hardy?
Yeah, so as you know, Emma Hardy is a concern area for us in terms of how we make that brand move forward. Done quite a lot of work over the past few months in terms of the identity of the brand and not rebranding, but kind of presenting the brand a little differently to the market. I now have a full team on Emma Hardy for the first time. As of 3 weeks ago, I now have a brand manager, which is fantastic. We actually took our ideas to our major listing, Marks and Spencer's, this week in terms of what we want to do, particularly in terms of POS and how we communicate in store and to consumers. And they were really pleased with how we're kind of stripping the brand back and going back to its origins. Like a lot of brands, that's a 10-year-old brand. When you go back to the origins of that brand and look at it today, it's still relevant. Emma herself was very ahead of the market in terms of what she was trying to achieve. And over time, it gets complicated. Brands get complicated. They get pulled about by retailers. You have this need and people tell you have to have new MPD all the time. And they get hence why it's got a tail. It's a much bigger brand in terms of SKUs than it should be. So we're just kind of repositioning it in terms of how we communicate to the market, taking it back to its origins and the original messaging and kind of moving the brand forward that way. So yeah, there's been quite a lot of work on that, which is quite encouraging in terms of moving that forward.
Do you see Emma Hardy living up to its potential as was imagined?
Do I see Emma Hardy living up to its potential?
As was imagined at the time of the acquisition?
Yeah, I mean, and it's been a tough one. I think Emma Hardy has got lots of potential. It's going to be a slower burn, I think, in terms of the growth that is going to deliver over time. The strategy that we've got that I put in place for Emma Hardy 6 months ago is to focus on digital because so much of it is sold in digital, is to focus on the core listing that we've got in the UK, but also on the travel sector. We think there is a tremendous potential for the brand in travel. We have got ourselves into duty free with Luton Airport. We've been there for 4 months now. It's gone very well. The goal would be to do more travel. In terms of its potential, I suppose it depends how you define the potential in terms of maybe what we paid for it. I think the brand can reach that potential. I just think it's going to take some time. It's going to take some time.
And the other question was, with the cost of manufacturing going up in the UK, do you worry about manufacturing moving overseas?
What, generally manufacturing overseas?
For the private labels.
You mean for our brands or in terms of competition?
Perhaps both, yes.
I think there's always a concern with manufacturing from overseas, but I think it depends on the quality, it depends on the lead times. And obviously one of the big challenges at the moment is the lead times on shipping. You know, shipping from the Far East, if you're bringing product in from China, used to be 4 weeks. It's now 10 to 12 weeks. So, you know, we have lead times that go out from China now. Used to be able to get product in total from door to door in about 12 to 14 weeks. It's now up at 18 and 22 weeks. We even were quoted 26 weeks the other day trying to get some product in from China because of the lead times on transport. Now, that's not necessarily always going to be there, but obviously there are all sorts of challenges that come when you're shipping from overseas, whether that be currency fluctuations, whether that be quality, whether that be shipping lead times, you know, whatever that might be. I think it's always has been, as long as I've been in this business, manufacturing from overseas has always been a competitive factor you have to consider. I think what we try and focus on is that quality, service and innovation mantra that we have in our business to ensure that we're hitting all of those points all of the time so that we can compete.
Can I ask about cost savings? So you mentioned a figure of 700,000, but you've obviously done an excellent job, you know, cutting costs in the last year or so. But do you think there's much scope to extend that further? Because you mentioned AI and things like that.
Yeah, I think there's always opportunities to review costs and see how we're doing things and be better at it. So yes, I think there are opportunities to continue to make costs more efficient. Absolutely.
I think just to add to that, it's not just about cutting costs just for the sake of cutting costs. It almost has to deliver value in terms of doing that piece as well. So as we mentioned, AER, we're looking at a warehouse management system that allows us to be a bit more efficient. You reduce, you know, effectively admin time, if you like, and being a bit more strategic in terms of how we utilize our personnel, our processes. So there's a whole host of things that we can do, and we have brainstormed, as Pippa mentioned, but it's got to deliver value as well, not just be a short term, okay, just cut overhead costs. We're quite lean as it is at the minute.
Yeah, sorry, I should have qualified my question. Said, you know, do things like software and you know, process re-engineering.
Absolutely, 100%. You know, one of our projects we've got going on at the moment is to make the manufacturing shop floors paperless, for example. So to really cut down on the time that we're doing in terms of administration. I think there's definitely savings in technology and AI for administration. We're exploring a number of opportunities. As Qadeer said, we've just signed off putting in a warehouse management system early into the new year, and that delivers considerable savings. So there's all sorts of things that we can do from a technology investment point of view, definitely, in terms of realising efficiencies and cost savings, for sure.
What is the impact of the increase in NICs and minimum living wage on the business?
So that's the 550,000 figure that I mentioned earlier, £200,000 on the national living wage, and then about £350,000 on the national insurance impact. So that's the direct impact to the business from April.
And do you think you'll be able to mitigate?
I think we can mitigate a fair chunk of that. Yeah, absolutely. I think, and that's the projects that we've got together as a team. We're setting ourselves a higher target to try and mitigate. But yes, absolutely. We've got a number of ideas on things that we can do, which include investments in technology as well, and software and various things, so that we can be more efficient and save cost. Yeah.
Pippa, which brand or brands have the most growth potential?
It's a very good question. I think Balance Active Formula's been on a really good growth trajectory over the past few years. We've just taken a bit of a hit because of these distributors in international markets. I think Balance Active Formula still has tremendous growth potential, as does T-Zone. We still have not taken T-Zone into international markets. So there is an opportunity with T-Zone. We've now got some interest from the Middle East. I think that will be our first international market launches. And we've got some interest in Europe. So yeah, I think our skincare brands, those two skincare brands, definitely. We keep saying we've got a little bit of a sleeping giant, and I think we possibly have in the Curl Company. It's a tough category as hair care, but we've got a really great brand. It does very well. Actually, it does more for us in international markets currently than it does in the UK. So I think there's an ability to extend that. But I guess if I was to rank them, Balance Active and T-Zone would probably be top of the list standing here right now. 6 months, I might tell you a different order of things depending on what happens.
And Qadeer, one on the tax rate, it was 28%, I think, in half one. Is that expected to be that level for the full year, and kind of going forward as well? What would you expect the tax rate to be? That's a little bit higher than it's been historically.
Yeah, historically. I mean, previously the R&D relief scheme was on an SME basis. Now that has changed, so that has contributed somewhat. We were on the small company scheme, if you like. So now we're getting an above the line credit. Also, in terms of the provision, we have made some judgments in terms of disallowing expenditure, which has upped the tax rate. So that will be a full review. I do anticipate to be between the 25 to 28% for the second half of the year, but we'll do a full-blown exercise with our tax advisor in terms of buttoning down that tax figure.